I want to talk about what's happening in the Middle East and how it may impact your portfolio. So, with the strikes that we've seen on Iran over the weekend, Iran, of course, has retaliated and effectively shut down the Strait of Hormuz. Now, 20% of the world's oil flows through this area, which in the short term is going to cause some volatility, but longer term could be inflationary. And it really depends upon how long this particular conflict endures. So, if that strait continues to be shut down, it could continue to put upward pressure on oil prices. If those oil prices start to get into the triple digits, over $100 a barrel, longer term, that could be inflationary. Now, we're going to get a jobs report at the end of this week. If we have weak jobs data combined with inflationary pressures because of higher oil, that could cause a stagflation type of environment, which is not good for stocks. This is something that we need to continue to monitor. Now, the good news is it's not likely that this strait will be shut down longer term. One, China gets most of their oil from Iran. So China's already putting pressure on them to open this back up. Also, 70% of the other trade coming into and out of Iran is facilitated through this strait. So it will be economically not in their best interest to continue to have this area shut down. Also, there could be military intervention from the US to effectively force this strait to be reopened. So we'll see how this all plays out. So of course, we need to continue to monitor one, oil prices to see how this plays out short term and longer term. Two, the duration of this conflict. Energy markets can deal with this for about a 2-week period by rerouting and dealing with current inventories that we have. But beyond that, this could start to pose some stagflationary risk. So we need to monitor this going forward. Now, the pattern around similar situations historically has been pretty consistent. So with the Gulf War in the 90s, with the attack on Iraq in 2003, what we're seeing with Russia and Ukraine, when the Saudi refinery areas were attacked, we see oil spike, we see the markets dip, then the market recalibrates once the supply situation starts to normalize a bit and we have a better perspective on that, then the market regathers itself and it continues to move forward. So that's what I hope happens in this particular situation. We need to position ourselves for quality. So if we're in a situation where inflation comes back on the radar screen of the Fed, they're really not going to have the latitude to cut rates in an inflationary environment. So we want high quality companies with strong cash flow. This is how I always position portfolios at any rate, because these companies are self-sustaining. They don't have to borrow as much money to fund their operations. If rates stay high because the Fed cannot cut rates because of inflation, then we want companies that are able to fund themselves without having to borrow money at higher interest rates. That's already a part of the portfolio. As you've always heard me say, I also include something called alternatives in the portfolio, meaning that assets that don't correlate to the stock market, nor do they correlate to the bond market. If we see inflation, that's not good for bonds. It could also cause a pullback in the stock market in the near term. So these alternatives provide an area that's not correlated to either asset class for additional protection and ballast through volatility like this. Now, I hope this is short-lived. I'm going to continue to monitor this and update you as necessary. This is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.